Welcome to the MarketEdge Tech Talk with Will Paule and special guest David Blake. We're going to review the market conditions of the past week as well as longer-term trends from a technical perspective, take a closer look at the major indices, and to wrap it up, dig into a handful of individual stocks and ETFs requested by subscribers. If you have questions or want to submit a stock for next week's webinar, email us at support@marketedge.com.
Hello and welcome to the Tech Talk for Tuesday, July 26, 2022. I'm your host, Will Paule, and I'm here with my co-host, David Blake. How are you doing today, David?
Doing good, Will. Thanks.
All right, let's start off with looking what the market's been doing this past week with a look at the market letter.
Okay, well, last week we had a strong rally in the market. In fact, it was one of the best weekly gains we've had since early June. We came into the week on Monday hoping to build off of the gains from the previous Friday where the averages were up about 2%. And we actually gapped up on Monday. Part of that reason was solid earnings from Goldman Sachs. They beat earnings estimates. I think the Dow was up several hundred points. And then all of a sudden, Apple came out about midday saying that they were going to slow their hiring and also their spending. And we had the market just kind of reversed course and headed south, mainly on weakness in the big cap technology stocks. Also on that, investors started to focus on a report from the ECB, however, that they were going to raise rates a half a point later in the week. That was the first rate hike they've done in 11 years. So the bulls like that. That they're getting serious about fighting inflation over there also. So we had a bounce back on Tuesday, and it actually was one of the best days the Dow's had since late June. The Dow finished with a 754-point gain. It was almost 2.5%. And then we had a little bit. We still had some gains going into the rest of the week. We had earnings from Netflix and Tesla come out. They kept the rally going. I mentioned a couple of times that last week part of the rally was based on earnings being less bad than feared, and that's kind of what Netflix had. Netflix jumped up about 8 or 9% on the fact that instead of losing 2 million subscribers, they only lost 1 million subscribers. Then Tesla said that they were looking to have almost another record quarter. We'll see how that turns out. So the rally kept going on Wednesday and Thursday. In fact, on Thursday's close, I think that was the highest level that the major averages had reached since early June. So we were closing in on those June highs. And then Friday came along, and we got an early warning from Snap and Twitter with their earnings. They disappointed. I think Snap went down something like 38% or something on weakness with that. That pretty much wrecked. That tech wreck kind of shook things up pretty much. We were still able to pull out good gains for the week. And while that was going on, we had slower growth prospects that weighed on crude oil prices. They came back below $100 a barrel. In fact, I think that on Monday or Tuesday they actually went down, touched $90 a barrel. But they closed at somewhere around 96. I think we had some. They were weaker yesterday, also at 94, and this is basically due to two things. Number one, the strong dollar weighs on prices, and then also just the fact that if we're going to a global recession, it automatically brings up less demand for that. Now, one thing we've seen the commodities actually had a little bit of a bounce on Friday with the CRB index moving up, but a lot of that was because of natural gas futures. They jumped 14% on the week, and I think they were up something like 5 or 6% on Friday alone. A lot that is Russia playing their little games about starting and stopping the pipeline to Europe. We also had wheat futures dropped, I think, on Friday early. They were down about 6.5% after Russia and Ukraine agreed to release Ukraine grains. That also got shook up with bombings in Odessa, so we'll watch that a little bit. But on that, during the week, we had yields moving lower. We actually had the 10-year Treasury go all the way down to about 2.70 and landed on about Friday at 277. That was its lowest mark since May. And then we also had the 2-year slip back below 3% on Friday on speculation that that the Federal Reserve on tomorrow could perhaps say that they're going to pause in September after they raise 3/4 of a point. I don't think that's going to happen. They'll talk about being data dependent, but I think they still need to keep going a little bit. And part of that's because you're not going to stop 9% inflation with a 1.5% over a couple of different times, 1.5% hike in rates. That's not going to happen. Okay, well, leading the market last week, we had consumer discretionary was the big gainers. Materials and energy were also stronger. Industrials and technology also outperformed. Again, part of that is the fact that we're coming into earnings this week on some of the big cap tech companies. I think Microsoft goes possibly tonight. I'm not sure. Texas Instruments. I think Google's Alphabet goes out this week. I'm not sure. I think maybe Apple perhaps too. So we're going to get a pretty good judge on what's going to, how earnings are going to be affected in the second half of the year. I do think that one of the problems with these big cap tech stocks being overweighted, if you get a miss or they trim guidance, they can pull the whole index down 2% if you have one or two of them just drop 3 or 4%. So it's going to be hard to read. You might want to keep an eye on the small cap Russell 2000 just to see how that is. Like today we have this is an example. This is on Tuesday. We have the Nasdaq down 1 3/4%. However, you only have the Russell 2000 down less than 0.5%. So again, the Nasdaq and the Nasdaq 100 are being overly pulled down on the overweightness of the big cap technology stocks. So keep that in mind. So it's not just if you see the Nasdaq down 2.5%, it's not we're selling everything. A lot of that weight is into the big caps. So that's something to keep an eye on. As far as the technical condition of the market goes, it did improve last week. We saw the different indexes break through some key resistance areas, and they also finished at their highest level in about 7 weeks. So it was gaining some good momentum. We saw most of the technical indicators return to a bullish configuration. MACD, which looks at kind of the short-term trend, it crossed in the bullish ground for most of the indexes and momentum. As I would like to look at that as the 14-day RSI. It's in positive ground, it's sloping up. However, it was right around 55, 56, 57. So it wasn't just zooming higher. But it had crossed into positive ground, which is a plus. Now, in addition to that, some of the things that we looked at last week on the tech call, we looked at the Dow Jones, S&P 500, Nasdaq. They were all able to break through a descending trend line off of the April to June highs. That it's a short-term trend line. However, that's something that still is important in the fact that over on the short-term basis, we are seeing a little bit of a change of direction. And then also we had the major averages close above their 50-day moving average, which is a big positive. That was the first time they've all traded above that. Now it's support. It was resistance level for the first time since April. So there's a lot of positive things going on. Nothing to hang your hat on, as I say. I got to jump in, but we're headed in the right direction. And I'm sure if you're watching your accounts closely, you at least got a smile out of some of the gains you had last week. Now, I did mention last week that I do think that we probably still have some upside to go. For the Dow Jones, I mentioned that I think we could probably rally to 33,150, maybe 33,250. That would be basically to the June highs where we started out. I don't know if we're going to be able to crack through that or not, even if we get a more dovish or maybe say a Goldilocks number from the comments from the Fed. I think that's going to kind of top things out. Now for the S&P 500, I think it has the potential to get to 4,150 to 4,200. And the Nasdaq, I have a target of around 12,350. As these targets looked a little bit better last Thursday and Friday. Now with a couple of days here of selling off, this is actually the third day now in a row that we've sold off. They don't quite look as good. But also at that level where we have the June highs, the 100-day moving average will come into play. So that's another layer of resistance that the indexes are going to have to break over, and we'll just see. So it's really hard to tell how the market will react to the Fed's announcement, and especially on the press conference tomorrow. That will just kind of that's going to affect it more than earnings. But if they're more hawkish, and then you have, say, Microsoft and Apple and Alphabet say that they're going to cut numbers or guidance for the second half of the year, you could start to pick up some more selling to the downside. If we do get a little bit of a rally here the rest of the week, that we go up to test these resistance areas, I would probably recommend that if you want to try to hedge those gains in, then maybe you could look at leveraging some your portfolio, and by that you could look at some of these triple leveraged ETFs and just kind of play them for a short term for us to maybe pull back and test some of the lows that we've seen. Okay, as far as secondary indexes, which I like to look at, we like to see if they're going to outperform or underperform the major average. We had the transportation index, Russell 2000, and the Philly Semiconductor Index all led the market higher last week. That's kind of a plus. Another thing we look at in here is we look to see if we see positive or negative divergences in the weekly charts. And I can't really say that I see positive or negative divergence. The weekly charts are kind of neutral. They're the momentum line was just basically getting ready to cross the midpoint. It was still below it on Friday, but it looks like it, but it was rising. You'd want to see that 14-week RSI, get up there in 55, pushing 60, to say that we're getting some positive divergence in that. So, like I say, a lot of times you look at that to see if the weekly charts are complementing or backing up what you're seeing in the daily charts. In this case, they're really not telling you anything. Okay, investor sentiment, we did see a little bit of an uptick in the number of bulls after the rally. Not sure what it's going to do this week. It's nothing big, but we might see another little bit of a tick higher. We did see some of the hedge funds add to exposure. They jumped up from 26.7% exposure the previous week. The last when Thursday's report that came out, they were about 44.5% exposed to equities, which is a pretty good jump. So I think that they're kind of expecting a short-term bounce here, also maybe coming out of the Fed rally, if they come in and say, okay, we're doing this and we're going to keep going. We'll see how that goes, whether they pull back after the announcement or not. As far as underlying breadth goes, we had a good week on that. NYSE and Nasdaq at AD lines were sharply higher. That shows broad participation in the current bounce. In addition, we've gone from about 4 weeks ago having 1,000 new 52-week lows to now we've contracted to the point where we're having only 40 or 50 new lows on the NYSE and the Nasdaq. So again, it's not we're not at a point, and there's nothing in the charts to say we're heading north and we're jump in here. This train's leaving, and you need to be on board. But I do think the oversold levels that we've seen are coming off. They're working off of that. We're no longer in an oversold condition on the charts by looking at several different. There's some longer term breadth indicators that show maybe that we're a little bit oversold, but nothing that says this is going to be anything more than a bounce in a bullish bounce in a bear market. So let's see what the Fed does tomorrow. Looking out, just to be aware, as of today, it's about a 75% probability that they're going to raise it 0.75 of a point. Still a 25% probability that they could raise at 1 point. That's down from 80% about 2 weeks ago. So the bulls seem to be focusing in on this 0.75 of a rate hike, which I think they're going to also do. As far as September goes, as of right now, the CBE FedWatch Group has about 50% of the participants are projecting still another 50% point hike in September. You have 42% are looking at another 3/4 rate hike. I don't think that's going to happen. I think if they do anything, they'll do 50 to maybe even a quarter. We'll see. And then you still have 8% on one going up 1%. And then in November, as I'm kind of surprised, you still have 44% on the Fed watch looking for another 0.5 point hike in November. So if they get what the majority is looking for, you're looking for 3/4, 1 1/4, almost 2% between now and November from here, which I'm not sure they're going to be that progressive. Remember, we've talked before in the past that it is the rate of the rate hikes more than the fact that they keep raising, and that's awful. That's really sticking to it, especially when the economy's slowing down. I believe we're already in a recession. We'll get the GDP later in the week, and you're starting to see companies talking about layoffs. I don't think they'll be that aggressive if they start to see some of these PMI manufacturing numbers come in contracting and going in minus. We had some last week, and I think that at some point you've got, even with the housing, new housing home sales today, we're down 8% and down 17% year over year. I don't think the Fed wants to just go, I'm going to wreck the economy just to get inflation down by the end of the year. They've got to be careful with that, or they can throw us into a deep recession, and that's not their idea. So I would be very cautious out there. And again, if we get up to where our target levels are, I would definitely consider possibly looking at doing some hedging on your portfolios.
All right, so you're still somewhat bullish over the near term and bearish over the long term. What could investors expect if you and other market technicians are wrong? Say the Fed is more hawkish tomorrow and spooks the market and we sell off. What can we look at on the downside?
All right, let's go ahead and pull the smart chart. I want you to pull up the S&P 500 and then stretch it out, going back to about 2019 down there on the bottom. And this is a tool, when you're listening to this, that is a helpful tool. I use this a lot, and I think we'll go over it today so you can use it in your work when you're at home. This is something you can use not only for the indexes, but also for individual stocks. So say if you bought a stock that you want to consider, we'll start down at the bottom in June, and then take the Fibonacci up to the high there in January on this. Okay. Now, as you look at this, the Fibonacci can also go when you break down from here. So we're going to be watching the lows from before. If we go down and test this low from where we were in June, you're probably looking on the S&P 500 going down to around 3650, 3660, somewhere in that area. That will we'll go down. We very well could test that level. Let's see. If you take your mouse and you go across there, you'll see the line will go all the way to the left. You'll see that bottom around in June was right around 3645, somewhere around there, depending on what day you have. And that will, that's where I think we will probably go down. We'll see if it's going to hold that. Now, that's also right around where the 200-day moving average is, and actually the or 200 week moving average is. So we'll have to kind of watch that. But if that would break, what you can do for yourself is go ahead and go down to the next Fibonacci below that. And what we do is this tool on smart charts. You don't find this very many places. It will show you the 0.236 would be the next minor support, which would then if you take your mouse and cover where that line is, that'll target around, like I say, around 360, about 3650, 3660 for the S&P 500. That would be your first low point. Now, if you stretch out over further to the left, guess what that coincides with? That pretty much coincides with where the S&P 500 peaked back in early January 20. So when you look at these lines and you put your mouse in there and go all the way across the chart, again, when you stretch these charts out, it automatically goes from a daily to a weekly chart. You're going to see other areas of support and resistance. So it looks to me like if we get hammered in here, we break this, I think that you have a real chance of going back all the way and just recouping the whole rally, or for where we started back before the pandemic, and go all the way back, and we'll start all over again from there. So that would be 33.60. If they do something stupid and they get everybody real riled up, then you go ahead and you look where the next target would automatically come in at the point 382 Fibonacci retracement or extension of this, and that's going to actually take you down to about 32.25, maybe 33.75, that area where you would find a next layer of support. I don't think it'll get to that. I certainly hope not. If we get down to that, we're probably going into a deeper recession than what we're trying to avoid. But if you can also use this, let's just say you want to buy a stock, and you put a stock in there, and you're looking at something that's pulled back. You're thinking, well, this thing's really pulled back. Let's look at maybe a bottom that's going to bounce off of this. If you do this technique with the Fibonacci retracement, you can actually put yourself in a pretty nice little sell stop and say, well, okay, I'll give it, the next fib retracement level on this, and that if it gets down to that, I'm gonna probably I'll sell it because then the thing's broken. Let's go ahead and take a look at the Nasdaq, Will. Okay, we'll do the same thing, except this time, of course, the Nasdaq peaked back in November. So extend the chart out back to around 2019. Let's draw the Fib chart in from the November bottom to the high. I'm going to do it on my chart here at home too. Okay, we use the same technique. If we come back, we come back to where the lows were when the Fed makes the announcement. Okay, we could go down to 10.6 on the Nasdaq. We hope not. If you go back, it's funny because if you go back, a year or so, oftentimes you're going to see maybe where something sold off and the chart came down and bounced off of that same level. So that's something to watch. If that breaks, again, then we're going to go down and we're going to look at the 0.236 area, and that's going to be around, believe it or not, around 9,300. I hope we don't get to that. That would be that would cause some people to get pretty excited about, and that would probably also mean that we're going into a deeper recession than we wanted to. And then, of course, the next target below that would go all the way back to around the 8,500, which I don't think you'll see that. But anyway, if those would be targets for the S&P 500 and the Nasdaq, if you see the June lows not hold up. Again, it's going to be because of bad news, and they're things are just getting worse with the economy here and in Europe. We'll see what happens. But you can use that technique on stocks when you're looking to buy something and go, this thing's way oversold. Like if you're looking at a Netflix or something like that, you could take from the high to the bottom and just see where a Fibonacci extension would take the stock to, and would help you set up a downside, or even if you're trying to short something, it would also give you a downside target for your shorts. But as of right now, let's kind of wrap it up. And like I said, tomorrow we get the announcement at 2:00, and then we'll have Chairman Powell's press conference beginning at 2:30, and we'll see what he has to say. I still think we're going for 3/4 of a point. Whether the market's going to rally or sell off on that, I don't know. And like I say, 25% of a lot of people think that we're going to get a 1%. They may be disappointed and sell the thing off. We'll see. But I don't think you really want to be front running what the Fed's going to do ahead of that, because it can go, it'll whipsaw you pretty quickly. And you don't want to invest with a what if, or I hope it does this. You want to have some good data behind you before you invest your money. So we'll see what he does, and we'll talk to you next week.
All right. Well, that's all we have for you this week. Remember, if you have a question you'd like answered on the next Tuesday Tech Talk, email it into support@marketedge.com or ask one of our live chat representatives to pass your question along to us for the next Tuesday Tech Talk. Thank you for tuning in, and we'll see you next week.